Hi, this is Kep Kepner, CPA here in Dallas. We're continuing our discussion about the benefits of an S Corp. So one benefit is the pro rata distribution of profits. If you're a 10% owner of an S Corp, you have to pay tax on 10% of the profits. That's easy. So if you have 5 owners, they each own 20%, they each owe tax on 20% of the profits. But let's say that you're a 10% owner and the 90% owner has a board meeting which you attend, and he says, we need to keep the cash in the company because we need it to grow. So then you have to pay tax on 10% of the profits, but you don't have any cash from the company to do it. So pro rata sounds really great, but the reality is if you got the big stick, you got the big stick. And there have been a lot of cases where owners of S Corps have been screwed by their majority owners because they got to pay tax on their share, but they don't get any cash from the business. An equitable way to do it is to distribute enough tax to each owner, pro rata, enough cash so that they can pay their tax. So that's what happens when you have a fair and honorable agreement with the other owners of the S Corp. Sometimes a pro rata share is not the right answer, and in that case an S Corp is not the right kind of organization. You could have a case where all the depreciation benefits go to one partner and all the regular profits go to another. And that can be handled in an LLC or a limited partnership, but not an S Corp. So, although it sounds great to be a pro rata share owner, it does have its drawbacks, and you need to understand these when you enter into this kind of agreement. Income and losses pass through to the partners. Well, that's great if you have a loss. Maybe okay when you have a profit if you get the cash. There are about 50 different tax attributes that pass through to the owners of an S Corp. With those attributes, you then have to include all of those on your tax return. So when you get that K-1 and you need some help doing your tax work, we can help. Generally, S Corps seem to be audited a little less than sole proprietors. But let's be real. If the IRS audits you, they're going to want to audit your S Corp. If they audit their S Corp, they're going to want to audit you. The two work together. So you have to have a solid financial and tax strategy, even though you have an S Corp. And maybe more so because you do, particularly if you have other partners. Business expenses can be deductible in an S Corp. Well, they can be deductible in almost any kind of business venture if they're valid business expenses. But let's say you have an S Corp and you as an owner drive your car for the benefit of the S Corp. So you want to deduct those expenses. Well, it's you wanting to deduct them, not the Corp. Well, there's a way to do that on your tax return. Unfortunately, one of the federal courts has ruled that that's not valid. So for that single owner, S Corp owner, then you've got a car, you've got office in the home. These are expenses you want to deduct on your S Corp. It may be years before all the district courts agree on the matter or before the tax issue goes to the federal Supreme Court, but the reality is maybe you can deduct those expenses and maybe not. There's a way to do it if you're really savvy about it. one of the greatest tax advantages of an S Corp is saving on Social Security and Medicare wages. So it's a strategy of separating your profit between profit and salary. The salary part is taxed for both Social Security and Medicare and income tax. The profit part is subject only to income tax. There are a lot of ramifications to this decision affecting how you put money in a retirement plan and what you're going to get in Social Security in the future. So you need to have somebody with that kind of savvy when you make that kind of decision. If we can help you, give us a call. Thanks.